Good morning. I bring you greetings from Lagos, Nigeria. Today we're going to be talking about something very interesting, which is non-interest finance, also known as Islamic finance. This video was inspired by the circular released by the CBN last month, which is essentially the revised guidelines for the operation of non-finance instruments in Nigeria. And it got us thinking that there's actually not much awareness on what non-interest finance is, or what Islamic finance is, or what the bandwidth of which it is. What we just mostly understand is that, when you talk about non-interest finance or Islamic finance, it means you can't earn an interest, but it's deeper than that. So the first thing to understand is that non-interest finance is a finance industry, a finance provision that seeks to cater to certain ethical conduct and principles that originated from the Islam doctrine. But it's also important to note that non-interest finance or Islamic finance also seeks to, achieve the same objectives as you have in your traditional finance and interest-based sector. They both have the same goals, which is to foster economic development, to foster economic growth, to ensure that their investment opportunities, they have the same goals. And interestingly, non-interest finance or Islamic finance has been identified as a significant catalyst for economic development globally, and it also prevents significant investment opportunities. And this is because it caters to the needs of a significant number of people who ordinarily would not be catered for by traditional products or traditional banking systems. So we're just going to start by understanding what are the principles of Islamic finance, what does Islamic finance entail, what does it allow or disallow, and we'll start with the history of Islamic finance in Nigeria. So the official first traces of Islamic or non-interest finance in Nigeria was first in 2004, when Jaiz Bank was issued a license to conduct Islamic banking services in Nigeria. But it sort of died down, and we didn't hear much about Jaiz Bank until 2011-2012. Around that same time as well, the CBN brought about guidelines for the operation of non-interest finance institutions. There are also other guidelines, but this video is not to discuss the guidelines, but to understand the principles that underpin such a system. So in the guidelines that the CBN essentially released, we know under the Banks and Other Financial Institutions Act that there's a banking model that recognizes different types of banks, one of which is a specialized banks. So the CBN indicates that non-interest financial institutions fall under specialized banks, which makes sense. So under this, we now have the non-interest finance institutions that provide their services based off Islamic doctrine, Islamic principles, Islamic commercial principles, and then it also recognizes that there could also be non-interest financial institutions that also provide services not based off Islamic principles, but based on some other non-interest principles. So that's just a summary of where we are in Nigeria. There was Jaiz Bank. There's also Stanbic IBTC came in next. So Stanbic IBTC has an arm that provides Islamic finance services, and I believe there are just a few more. It's still an underdeveloped sector in Nigeria that has prospects for tremendous growth. So now understanding the principles is the next thing that we're going to do. So now we're going to look at the principles that underpin non-interest or Islamic finance. And there's one thing that I just want us to understand. So while the objective of non-interest finance or traditional financing might be the same, Islamic finance is concerned that not just the result, but the transaction itself, the process and manner in which it's conducted, the parties involved, the business activities of the parties involved, and a whole lot of other factors. That's where it's distinct, that's where it differs. So while the outcome might be the same, the process is not the same. So there are three different industries across which Islamic finance covers. So it's when we look at traditional banking, traditional financing, when we think about bank loans and things of that nature. Then also when we think about insurance, because insurance is also like a financial transaction where an insurer is providing an indemnity and you are paying a premium. And then lastly, when we look at equity and debt investment. So Islamic finance makes major adjustments to the way in which these three sectors are conducted traditionally. So when you look at traditional financing, the idea is that you borrow money and then you repay the money back at an interest. Now, under Islamic finance, the principle it doesn't make sense in the sense that Money is not a commodity. You don't buy money, you don't trade money. Money is just a means of exchange. So how do you can't make money from money essentially. You can't make money just by money. There needs to be something that is tied to that transaction. There needs to be a good, there needs to be a service that is tied to that transaction. So that's why it prohibits interest. And this concept is known as riba. I'll leave the spelling of all the Islamic wordings that I use on the screen so that it's also easy in case my pronunciation is wrong. So this is the most common application of Islamic finance. The idea that you can't make money from money. If you go into a transaction, the value has to be predetermined, and you're not supposed to pay more than the principal that was attached to it. Now, there are different ways in which, so like I said, it's a transactional thing. Now, many might mistake this to mean that, oh, the banks are not supposed to earn any form of profits. No, that's not what that means. What that just simply means is that you can't make money from money. There needs to be some form of asset or transaction that is tied to it for you to be able to make a profit. And there are a few concepts that are operated by the different participants to be able to earn a profit. Now, the first thing that we will talk about is the mudaraba. Mudaraba. In this sense, what happens is that the concept is that the bank or the investor brings in the capital, the entrepreneur brings the skills or the service, and then they go into transaction together. If the business fails, then the investor bears the loss, and then the entrepreneur doesn't get paid. And then if there's a profit, they split the profit at a predetermined rate. So that just means that the investor and the entrepreneur share in the profit and the loss. Just to go back to understanding Islamic finance and the principle, Islamic finance is a community and entrepreneur-friendly approach to finance. So you would see this play out in the different principles. So we're still on the first principle, which is interest, which falls under the traditional banking lending area. We're talking about how Islamic finance governs this. So we've spoken about one way through which they avoid the typical I lend you money and then you pay back in an interest. So the first, like I said, is the mudaraba, which is where the investor brings the capital and the entrepreneur brings the skills and they split the profits. The second is the musharaka. So what happens here is that it's similar to a joint venture. Profits and loss is also shared in a predetermined manner, but the joint venture is a separate legal entity. Now I'm going to link this back to equities. So when it comes to investment in equities, in shares and stocks, this is usually the concept under which that falls under. So Islamic finance is fine with you investing in securities because you're investing in securities and then you're becoming a shareholder of a company and there are other shareholders involved in the company. So it's sort of like a separate entity from you and you have a pool of investors. So it falls under the idea of the musharaka. So when it comes to equity, what Islamic finance will be bothered about is the activities of the company. Are the activities of the company legal from the Islamic perspective? So, for example, a company that sells alcohol would not be Islamic friendly, or a company that engages in gambling or certain types of entertainment, or a company that deals with the sale of pork or deals with the sale of non-halal products. So those who now there is concerned about what the company does as opposed to the equities, because the equities nature of equities is already covered under the musharaka. But what will not be covered is when we look at debt, and then under debt which is why we have things like sukuk, and I think sukuk is quite popular in Nigeria. So when it comes to debt, the idea is that I can't just my interest if I put down money, or my benefits if I put down money cannot just be tied to debt. It needs to be tied to the ownership of something. Like I said, money is not a commodity under Islamic reasoning. Money is just a means of exchange. So what happens here is that rather than your debts being tied to just debt against the company, which is a claim against the company, it needs to be tied to ownership of an asset of the company. So which is why you usually have your sukuk certificates that tie you to the ownership of a company. So now we've dealt with the equities, the investment side of things, and then we'll still come back to discussing the traditional lending. So like I said, the different solutions to that we've mentioned are the mudaraba and then the musharaka, which was where I explained the equities. Now the next will be the murabaha. So what happens here is, you know how in traditional financing, I want to buy a house, so I go to the bank and then I get a loan and then I go and buy that house, and then the security for the loan can be the house. That is not how it works here. What happens is that the bank goes and buys that house and then sells it back to me at a higher value. So as opposed to giving me the money and then charging me an interest, what happens is that the house is what they're giving in this. They're not giving me money, they're giving me the house, but they're selling to me at a markup price, and that is how they make their profits. So that is the murabaha for you. And the other things like the ijara, which is a leasing arrangement, and there's also the base salam as well, amongst others. Now I want to talk about the takafu, and that falls under the third line of industries I spoke about when we were speaking about Islamic financing, and that has to do with the insurance sector, and that will also go into one of the principles of Islamic finance, which is that there can be risk or uncertainty or speculation. More specifically, there can be uncertainty, which is called gara, or gambling, which is called misa. When I say gambling, I mean one party cannot benefit at the detriment of the other. When I say uncertainty, the gara, what we mean is that you can't go into a transaction knowing that, well, I'm going to pay premium, but then I'm not even sure what I'm going to get out of this eventually. There must be certainty. In fact, parties can opt out of contracts if what they contracted for is not what is happening, if there's uncertainty at the end of the day. So it's very important that there's no risk or speculation. These are fully prohibited in any transaction. Parties must be aware of everything. So what you have here is that the way that the takafu works is that all the parties in risk is pooled, and then the insurer is a party, the insured is a party, and they also share in the profit and loss as well. Also note that insurance companies must also invest in Sharia compliance investments, just like we spoke about. So members of the company are both the insurer, that's the insurance company, and also the insured. Premium, usually in traditional finance, premium is uncertain and indemnity is uncertain, and under Islamic finance, transactions cannot be uncertain. But the exception to uncertain transactions are unilateral transactions like donation contracts, donation agreements. So one way to cure this is to have a donation agreement amongst the participants, so where the insured is donating a certain amount, which would be usually what you get paid for in the event that the insurance is triggered. So yeah, that's just a way to get rid of it. Either the parties that come into a company together and they share the risk and losses, or it occurs in more of a donation manner, a donation contracts manner, and rather than in typical indemnity contract. That also solves it. Like I said, these are concepts that we can speak about under many videos, but we'll leave links to help also explain it better. But let's just have an idea so we broaden our understanding. So that's another thing to note, is that Islamic finance is not restricted to non-Muslims and to Muslims. Non-Muslims are actually allowed to participate in it as well. Another thing, like I said, is that products, it looks at also the products that are involved. So investments must be in Islamic compliant products and services. So make sure that you also take notes of that. So yes, these are the major components. The major components have to do majorly with riba, which is the interest, have to do with uncertainty and gambling, which is the agara and mesia. And yeah, so that's just the major thing. So I think what I want us to take into consideration is that the objective is the same. The transaction and the idea behind it is different. The idea is that when there's money involved, money is just an exchange it's just a means of exchange. So it's not a commodity that you can use to make more money. So for you to make more money, it needs to be more structurally carefully. It needs to be structured more carefully for there to be something from which you're making money of, which is why we have the things like the mudaraba, the musharaka, the murabaha. These are structures in which both parties can benefit, but at the same time it doesn't offend Islamic law. Then when we look at the insurance aspect as well, is also the thing of why should somebody be paying a premium and then the other party is making money off money, and then it's uncertain, you don't know how the transaction is going to play out. And then yes, also investment, the debt as well. How is something just tied to money? Money is meant to be tied to something, except you structure your way around it. And then I think that's pretty much sums it up. I think that we've been able to provide just a broad summary of what the principles of Islamic finance are, and also how it fits into the economy, which is that it caters to a huge, I believe the statistics are about that Muslims make up for about a quarter of the world's population. So imagine being able to include those into financing, into insurance, into just the general economic system. It's really an economic booster, and also the fact that it has the same objectives, and it also both all parties in it in the ecosystem can also benefit. It's something that should probably be looked into and expanded into other countries as well, so that there's more inclusion. Inclusion fosters economic development, as we know. And so yes, we look forward to more development in this sector and more understanding in the sector, so that Muslim participants can also partake and probably develop products. Like I said, in Nigeria, the development of this sector has actually been low. What I read from an organization that fosters this is that Islamic backed products only make up for about 1% of Nigeria's economy when it comes to that aspect. So there's still a huge avenue for growth. So yeah, thank you so much. Tell me if you've been able to learn a thing or two. Are there other things that you think that were not included here? If you're a scholar of Islamic finance, or just a scholar of Islam generally, what are other interesting finance principles that you're aware of that you can share with us? We'll see you in our next video. Thank you very much.